Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm going solo again to give you what you want, some more stock picks. But this time I'm going to focus on the old economy because, believe it or not, there's some old economy companies, some that have been around nearly 200 years, that are busting out here in 2024. So some of these stocks on the old economy side have been red hot. And maybe you've been ignoring them or just avoiding them because for many years they were not going anywhere. But maybe it's time now to take a look at some of these other companies that are in the sweet spot. Some of them are involved in the AI build out, and that's why they've been, deployed back in action, basically, after all these years. But others are not necessarily in the AI side of things, but are benefiting from things like the infrastructure build out in general in the United States. So what are these red hot old economy stocks? Let's dive in and see what they are. Now, remember, I'm doing this as a video podcast and an audio podcast. So if you do have YouTube, I do suggest taking a look at some of the charts that I'm going to show. And we're going to take a look at the earnings estimates for these companies, because that's key to what is going to be happening here for the rest of 2024 and next year as well. And so if you want to see all of that on your screen, I'll be sharing on Zacks.com some of that information. So watch it on YouTube. Go over to Zacks.com/YouTube to get our YouTube channel, or just put in Zacks Investment Research to get it there. Otherwise, I'll try to describe what I'm seeing for all of you who are just listening to this on Apple and Spotify and other podcast platforms. But as always, we have both in case you want to check out the charts visually. Okay, so let's check out those charts on the first stock I wanted to talk about, which is United Rentals. This kind of gets like a lot of derision, I feel, by some of those who are big tech investors or big growth investors, because this is an old economy stock that rents out equipment. So that's old hat, and there's not anything super glamorous about it, except the equipment has become very technology based. And they rent out in North America in 49 states now, and all the provinces, or at least a bunch of them, up in Canada. And now that we have the infrastructure bill, as I was mentioning, in the United States, there's been a lot of construction going on. So you have, residential construction. You still have commercial construction, including on hotels and resorts. It's going into things like airports, bridges. All of this needs equipment, and it is being rented. So United Rentals been having a couple of good years here in a row, and the stock has really taken off. Now, I took a look at some of the 5-year charts for these stocks, and I'm going to do that on Zacks.com. So I already put in the ticker, and you can see United Rentals. It is a number 3, which is a hold. It's pretty cheap. Its style scores are Bs across the board, but it does have an A for the compilation, the VGM score. But the others are Bs, both value, growth, and momentum. And just scrolling down, you can see why it's got the B in value. Its forward P is 14.6, even after the big run that it's had. And this now does pay a dividend yielding 1%. I used to not like United Rentals because it wasn't paying me a dividend, but they did have share buyback program. But they finally did decide to reward shareholders, and they're paying that dividend now, which is 1%, as I mentioned. Okay, so you can find the detailed estimates, because that's what I want to look at. On the left-hand side, there's a column there that's in the dark gray, almost black, on the left-hand side. And if you look down a little bit under Zacks Research category, it says detailed earnings estimates. So I'm clicking on that to find out what is happening with sales and earnings. So I scroll down and you can see sales expected to be up 6.5% this year and 3.5% next year. That's pretty normal for a slowing slower growing company like United Rentals. Earnings expected to be up another 7.3 this year and 7.6 next year. Very nice earnings growth with United Rentals. You know, my favorite chart is the price and consensus. It's under the charts category on the left-hand side, and I'm clicking on that to see what the earnings growth is looking like. And this is a very nice price and consensus chart. It's up and to the right for the most part, but some of the earnings growth is slowing a little bit here in 24 and 25, back to that single-digit earnings growth. But stock is still pretty cheap, and it's come off of its highs. So it's pulled 11% off of its highs in the last 3 months. And so you're getting a little bit of weakness here that we haven't seen since last year. And maybe this might be a buying opportunity in United Rentals. We'll see when they report the next earnings what is actually going on there. But some people cashing in after huge gains. 5 years, it's up 409%. And that's putting it up there with a lot of other big technology stocks. So if you have been patient and have owned this one since pre-pandemic, you've really been rewarded with the shares and now the dividend of 1% now. So United Rentals, we'll see how much more gas does it have in the tank. Maybe this is just a timeout, but its business is really growing right now with all of the build out that's happening. So United Rentals, ticker URI. My next stock is one that I've talked about many times and I now own, but only because a different company I owned was bought out by them. So it is big oil. It is Exxon Mobile. And this is as old economy as it gets too, along with United Rentals. It's been in business since 1866. So 148 years now for Exxon. And as I mentioned, it just recently bought Pioneer Natural Resources, one of the biggest Permian drillers. And so it's integrating that deal, but that's going to give them even more production as we move through 2024. So what does this stock look like? Forward PE is at 11.9, so almost 12. Stock has pulled back since it closed that deal. It did hit a new all-time high earlier this year, but it's pulled back off that. So 3 months now, it's up only 3.4%. And 5 years, it's up, but just 50%. And that is underperforming the S&P 500 over that 5-year period. But these stocks on the energy side had been so depressed for so long that this is actually kind of a nice rally for Exxon here. Dividend is still huge, paying a yield of 3.3%. Let's look at what those earnings are expected to do. Now, oil and natural gas prices have come down. We got to get on the detailed earnings estimates tab. And so that has impacted earnings. It's not expected to be negative anymore. It was, but analysts must have been raising their estimates a little bit here since the Pioneer deal. It's kind of mixed. We have 5 higher in the last 60 days for this year and 3 are lower. But they're now expected to grow earnings, but just 0.5%. So a little bit higher than what they made last year. But if you think oil and natural gas have bottomed, then hopefully it's only going to rise from here. Next year, 2025, they do see 7.5% earnings growth for next year. All of this will change if you see continued upward movement in both crude and natural gas pricing, because then obviously that goes right to the bottom line as well. So Exxon Mobile, what does its price and consensus chart look like? It's, you can see the big sell-off here. Well, not really sell-off, but decline in the earnings after 2022, which was when crude went up to over $130. And then they were just crushing it on the earnings side, just huge free cash flows, tons of money pouring in. But the shares really haven't given back much. It's kind of stayed in this narrow trading range in between 100 and 120 for most of the last year and a half now. So what will the next move be? Will it be a break up, or will we see it finally fall back under the 90 level is what I would think it would have to be, go back to really have a breakdown, and then maybe hit that low there in 2022, which is just a little bit under 90 there. Wait, it actually will tell me 85.75. So this one is interesting. It's all going to depend on the commodity. So keep that in mind. It's always about the price of oil and natural gas, and as well chemicals with Exxon Mobile. So that's Exxon Mobile, ticker XOM. I now own it once again in my portfolio. Third stock is one that I have talked about, but you might not think about it as being old economy, but most of the companies that it owns are old economy. Berkshire Hathaway, ticker brk.b. And these are the B shares. And Berkshire did hit a new all-time high earlier this year. It has pulled back a bit off that high. We have it up over the prior 3 months, but just 0.1%. So it's just kind of hanging out now in between this $400 level and the all-time high, which is $430. So it's just been hovering right around here. The shares have gotten more expensive. So that could be part of the reason why it's, kind of just in this holding pattern. It's trading at 22 times. But on this one, if we scroll down to see what the earnings are looking like, we only have a few analysts covering it because it's just so huge. You kind of would have to just be a Berkshire covering analyst because it's in all these industries. So it's a little weird to position this company. But this year, earnings expected to be up 8.9%, and then another 6% for next year. So the stock really rallied on this great earnings growth story for this year. That's not easy to do with a company that has sales of $368.4 billion expected this year. Sales are only expected to be up 1%, and then next year like 1.6%, because this is old economy. It's paints, it is energy. They own a huge railroad. They own insurance companies. They own furniture retailers. They own flooring. They own housing in the, not RVs, but in the prefab housing. So they're in almost everything, but a lot of it is the old economy. But as I mentioned early on, old economy is kind of having its last laugh here as these stocks are growing, these companies, and the stocks have been hot. So Berkshire's price to consensus chart is a little mixed bag, but like I said, it doesn't have many analysts covering it. So it is up and to the right, but now you can see in 2025, the analysts are a little more pessimistic there, and that consensus has come down off of recent highs this year. And but you see 2024 looking pretty good here with that 8% growth. So it's not all bad news, but stock might be a little pricey here for this kind of earnings growth, which is why it's taken a timeout, at least for now. But Berkshire Hathaway hitting new all-time highs here in 2024, ticker brk.b as in boy. Okay, then we're going to switch to a company I'm not sure I've ever covered. It didn't seem familiar to me, but maybe I mentioned it on one other podcast. I'm not sure. But it is, what is this mysterious company? It's Schneider Electric, SE. And the ticker is S as in Sam, B as in boy, G as in George, S as in Sam, Y. So it's one of those 5-letter companies because it is a foreign company. It's French. Now that I say that, I want to say I have covered this in the past. That's going to mean it's not heavily covered by the analysts because that's what happens to a lot of foreign companies, even those big ones like over in China, like Alibaba. But we do have some coverage. We do have a rank. I've just brought it up on my screen. It is a number 2 Zacks rank. That's a buy stock. But you can see here under the industry rank, it's in the top 9% of the industry rank. And that industry is manufacturing dash electronics. So that's pretty old school too, in the top 9% of the industry rank. So something good is going on in manufacturing slash electronics for it to get that high of rank. Now, we have a forward PE on Schneider of 28, a PEG of 3. So that's not real cheap here. And they do pay a dividend. It's yielding 1%. But on Yahoo Finance, it tells me it's yielding 1.5%. So this is like a variable dividend. So it depends on what they report the next quarter, and then the yield will change. So Yahoo Finance is a slightly different dividend payout. And so that's why it's yielding 1.5% over there. But they have raised their dividend payouts for the last 14 years as earnings have grown on this company. So let's look and see what earnings are looking like on this old school company. We only have one or two analysts covering it, and it is on the full year, but we have earnings estimates up 11% this year and another 10% next year. Now, this is the oldest company I'm going to talk about today, older than even Exxon Mobile, if you can believe it. It was founded in 1836. It is 188 years old. So it's been around through everything over all those years. And this company is big right now. And why is it red hot? It's hitting all-time highs is because of the data centers. And this company is like a lot of those companies that service the data centers through the cloud, through products interior on the data centers, through energy management at the data centers. And so that segment is red hot. So I took a look at their first quarter results because I wasn't that familiar with this company. And revenues were up 5% organic. It was an all-time high for the first quarter in revenues for this company. Think about that, all-time high. It's been around 188 years. Energy management, that's one of the divisions, was up 8.9%, led by double-digit growth in North America and the rest of the world. So huge growth there, as we've seen with all of these companies on energy management and the data center side. Industrial automation is their other big category, but that was down 6.6%. And then they did give some more color, like globally, because this is a global company. That's why I do like it. So the data center story is not just North America. It's not just America. We're not the only ones that are going to have Chat GPT or self-driving cars or any of this stuff. It's going to be global, and that means the build out has to be global. Data centers are going to go in everywhere, right? So this company is at the forefront because they already do business everywhere. So they said China was growing in both categories, energy management plus the industrial automation. India was up double digits. This is all in the first quarter. Middle East and Africa were up double digits in both categories. So somebody had to be down pretty bad in industrial automation to make it go down 6.6% overall. And I have a feeling that was probably North America for some reason. But the company did say they expect the discrete automation, which is where the weakness is in that category, to pick up in the second half of the year. So they did reaffirm their guidance for the full year as a result. So, they are holding true with what they're thinking they're going to see with this double-digit earnings growth, and also sales at double digits expected up 13.5% this year to $40.8 billion, and then another 6.5% next year. So what does this look like on the chart? Now, I did have trouble finding a lot of information on this company because it is foreign and it's not widely followed. It trades on over the counter, which isn't super strange for foreign companies. Many foreign companies do. So it does have lower trading volumes because it's on the over the counter market, but and it did not have, as you can see here, I'm showing the price and consensus, but there isn't one because we don't have quarterly changes in the consensus with this one. We only have full years. So we're not picking up on the usual data we would pick up on for the price and consensus chart. But you can still see from this chart that the shares have hit new highs here in 2024. What are they up? So 3 months, they're still up, but up 7% over the last 3 months, but they are off those highs that they hit recently. 5 years, they're up 195.5% to these new highs. And a lot of that has come in off those 2023 lows that you can see there, where then the AI data center story is really taken off. And it has even with Schneider now, too. So even over in France, people are figuring out that this is just going to be a huge growth driver for these companies. And so we should see this for the next several years. Like I said, it is trading at 28 times, but that's cheaper than some of its competitors on the global stage in this category, like Vertiv, ticker VRT, which is trading at 40 or 45 times now. That's a US company. And I own that one in my own personal portfolio and in Zacks value investor portfolio. But this is an old economy company, Schneider Electric, in the same category. It's a bit cheaper, probably because it's just less known to U.S. investors. But someone's figured it out because it has gone to these new highs in 2024. So the ticker again on that one is S as in Sam, B as in boy, G as in George, S as in Sam, Y. SBGSY for Schneider. And then I'm going to finish it up with another old economy, real boring company, but it's found new life, not because of the data centers, but because of the demand on energy. And this is in clean energy. So the company is Constellation Energy. It's ticker C as in Charles, E as in Edward, G as in George. CEG, this has been one of the hottest stocks out there this year. It was hitting new highs because this is one of the biggest nuclear energy companies in the United States. It's been around a while, goes back to 1995. It was owned by Exxon Corporation, and it was spun off in February 2022. So that's why, if you're wondering, like, why haven't I ever heard of this company before? Because it really only has been around in this form in the last 3 years. So it is a number 3. That's the hold. And you can see it's surged so much, it has no value. It's got a D style score for value. But even on the growth side now, it's a D, but it does have the A for momentum. And this is in the alternative energy category, but you can see that its industry rank is quite low in the bottom 39%. But there's a lot of different companies that are in alternative energy. And this one, nuclear, happens to be among the hottest. So its forward P is now 27 and has a PEG of 1.8. Neither one of those is all that cheap. Dividend is 0.7%. So you'd think when you're buying like an energy company, you might get a bigger payout on a dividend. But they've been doing a huge share repurchase program. So in the first quarter, they spent $500 million on a share repurchases. And then since 2023, they've repurchased $1.5 billion. That's a lot of money. And they also, in the first quarter, raised the share repurchase program by another $1 billion. So they're still really repurchasing those shares, but also paying this small dividend yielding 0.7%. So what does this one look like? Why is it on fire and hitting new highs here in 2024? So I'm scrolling down to look at its sales and earnings. So sales expect to be down 4.9% this year, and then up only 1.4% next year. This is what you might expect out of a utility, right? There's not going to be like some crazy growth there because they only have a certain number of states so far that they have are servicing the customers in. I think it's like 6 or 7 states. It is over 20 million businesses and residences. So it's a decent market, but it's not nationwide, not yet. But earnings, look at this for earnings, up 51% this year, expected to be up 13% next year. So people have really been buying this earnings growth. You can see the analyst estimates are going up in just the last week for both this year and next year. And is this still a number 3? I'm kind of surprised it hasn't moved up to a number 2, which is the buy, with these estimates being revised higher just in the last week. So we'll have to watch that. I feel like that the rank may go up to a number 2 with those earnings estimate revisions. Now, what does this price and consensus chart look like? It is up and to the right with a 50% earnings growth expected. You would think it would be pretty good, but it is pretty dramatic here. And so the stock is also dramatic. It's at these new highs, but it was only spun off in 2022. But over the last 2 years, since I couldn't do the 5-year returns, 2 years up 209% in the 2-year period. And over the last 3 months, while it's off those recent all-time highs, it's still up 18.7% in the last 3 months. So this has pulled back a bit off those highs. Will we get a buying opportunity here? It has done that a couple of times where it's gone up to new highs, pulled back a little bit, but then it's resumed its growth higher. Will it do that here, or are we going to test some of these other 2024 levels of resistance here on this chart? That remains to be seen. We'll see. But this one, Constellation Energy, has been one of the old economy, utility stocks hitting new highs, red hot here over the last 2 years. And we'll see if this can continue. But all these charts really show that you shouldn't rule out the old economy stocks, because if they're good companies, they're changing their business models to fit what's in demand today. And for Schneider in particular, they've changed what they've done over the years many, many times since their original founding all the way back in 1836. So, the original founders would not believe what that company looked like today. They would have no conception of that. So that's good companies. The same could be said of Berkshire Hathaway. Original Berkshire Hathaway was founded, I had to look it up because Warren Buffett only took it over and created the Berkshire Hathaway Corporation in 1965, which seems old, but not really when we're talking about Exxon and Schneider being as old as they are. But Berkshire, the original company as a textile manufacturer, was founded in 1839. So that has gone back all the way, almost as old as Schneider. But the textile manufacturing is no longer, the big part of the business anymore, obviously. And even what it looked like in 1965 when Buffett bought it, it has changed tremendously. It no longer owns the newspapers. Remember when it owned all of those newspapers for the classified ads? And a whole host of other businesses have gone by the wayside in that period of time. So all these companies, they may be old economy, but if they're catching on in the new economy, that's when it's interesting for those of us who are investors. And a lot of times you may be able to get these old economies at just a better entry point, a more attractive buying price, not the price of the stock, but at the valuation levels of a PE or a PEG or even a price to sales ratio. So keep that in mind too, that it's not where the stock is does not necessarily make it expensive or cheap. It's what you're buying those earnings for that makes it expensive or cheap. But these stocks, we want to just red hot old economy, and we got it. Some more attractive than others, but you can't deny what these charts are looking like here. So don't rule out some of these old names. There are other ones I totally could have included on this week's episode as well. But that just goes to show you, too, that we're seeing really good results from a lot of different types of companies right now. And it's not only the AI plays. or even technology that is on the forefront. So let me recap the stock tickers again here. So we had United Rentals, ticker URI for that one. We had Exxon Mobile, ticker XOM. Then we had Berkshire Hathaway, brk.b. Some sites have it as a slash, brk/b. But if you just put in brk, usually it into like the quote bars on most sites, it starts to populate up with the A shares or the B shares, and you can just click on that. But keep that in mind. These are the B shares. So those are the cheaper ones. And then we had Schneider, which is SBGSY. And then we had Constellation Energy at CEG. And another thing, I could not find Schneider on StockTwits, but there was a separate Schneider Electric thing floating around there that had like 189 followers. I'm not sure if it's the same. It had a different price, I think, on the stock price. So I'm not sure about that one. But yeah, there's something is strange with that one. But you can find Schneider on Yahoo Finance, and it does have the rank on Zacks.com. So you can find it there. But a lot of these interesting tickers this week, and keep them on your watch list. So, and also keep us on your watch list. Be sure to subscribe so you don't miss a single episode. Get us on Apple. We are on Spotify. And of course, as I mentioned earlier, get the video on YouTube so you can see all these charts, but get us somewhere. And I'll see you again next week with some more stocks.